Three, two, one. Good morning, Vietnam! This is not a test. This is Elk Radio. Hi, this is Ian Kebblewhite, and it's great to be with you, bringing to you Elk Radio Show 1, Part 3. Wasn't Robin Williams the most amazing person? Just a brilliant, so funny, the funniest person I think I've ever seen in history on everything I've seen and watched. Just so goddamn funny. But just so naturally good at just being funny and entertaining, and that led him obviously into acting. But I think as an actor, he's probably one of the best actors I've ever seen, and I'm a movie buff. I love movies and I love well-written and great TV series. But Robin Williams, he was able to get across everything. If you look at those genres of comedy and then comedic type movies through to very serious, and the one where he played the doctor dealing with sick children was probably one of the best acting plays or acting parts I've seen him portray. But as an actor and a comedian, he did and got across all those areas so well. And look, it's drawing a long bow, but that does relate to how Elk goes across everything that we do, and we do it really, really well. And I say that because I'm proud of what we've done, and to put our best foot forward to our members, I'd like to make sure you're aware of that. And so that's what today is really about. It's to show you the proof of delivery, what our simple plan, what Part 3 is about, progressing from Part 2 of Show 1, was to go through and show the strategy, structure, and solution that needs to be put in place as the first step. And I'd argue with nearly everyone that nearly 90 to 99% of Australians, so I'd argue with anyone, that nearly all Australians should be looking at this as the first step to get the foundation in place that they need to launch from as part of building the wealth they need for their future, and having the solution in place to deal with those issues and deficiencies that were very much identified in Show 2. And those issues related to tax, mortgage, retirement, and then the lack of a plan of how to fix that, and the real world aspect of how does that make you feel, because you're doing it day in, day out. And the logical part of it as well is, well, what do you think about that? So, much more upbeat, hence the start, a bit crazy. My apologies if I blew anyone's eardrums out. But I'm passionate about this, and I want to apologise for being affirmative when we know, proven, that this is a structure strategy solution that is without peer because we've got the ability and expertise to put it in place. So, let's get into it, and you know what? Before I do, I had something in mind. And yesterday, when we were doing Show 1, Part 1, Part 2, I reflected just briefly on Part 2, and my goodness, if I've ever misspoken or taken a misstep, it would have to be in relation to this comment. I made the comment in relation to my wife, Emma, and she hasn't listened, and certainly no feedback has come my way. I would have liked Daryl, our show's producer, and perhaps the director, to step in and go, wait a second, we've got to stop, and step in and go, stop. Ian, backtrack, let's do that again, let's take that again. And not that these takes are actually done any more than one. This is coming to you live. It's coming to you because this is what we do. This is how we say things. This is our language, and we know it in a situation where we can dive deep. So with that, if I pause or correct myself, please it's live radio. So run with it with me, please. Now, as I was saying, misspoke. I made the comment, I'm glad I made the decision. That was the word. I'm glad I made the decision to marry Em and have our beautiful family. Wow. Let's backtrack on that. I am so lucky and so grateful that Em chose me, and that I'm so lucky that I was able to be the one as her husband going forward. So I think if you listen to Part 2 and now with Part 3, I'm back in good standing. So, and just talking about standing, and I suppose leads me to what I do in my spare time, and I'd love to hear from our members in terms of what you get up to. But for me, I'm a runner, and I run daily, 5 to about 8 Ks a day, and running fixes everything. Running is the most amazing one. It's hard work, but it's the most amazing form of exercise. And if you're not able to, then something like it maybe a recumbent bike where you can really push out from your legs and your stomach will really give you a similar kind of result. But running for me, and I suppose running is important because, or any form of exercise at the moment, because I think Australia's alcohol sales are up about 80%. Yep, they are. The alcohol sales in this pandemic and due to isolation across Australia are up 80%. Now, that's a lot of alcohol. And I suppose to get rid of that, maybe a form of exercise. And I know I've had a few drinks, more than I normally would. In any situation, I think we've just been non-stop, and it's been good to have a beer. I've had a few birthdays, of course, with my children in the last month or so. So that hasn't helped. But yeah, running, that's my outlet, and that's the way in which I'm able to get that clarity in terms of what my goals and objectives are, and really the positiveness to overcome anything that's coming our way in this environment. So I'll share with you some photos of the run this morning around Burleigh Hill. It's just an amazing part of the world where we live. And so, as I was saying, let's get back to the structure, strategy, and solution. So with the structure, strategy, and solution, we've identified that, hey, there's some issues and some deficiencies. How do we fix that? Well, how we fix that is we've got to take control. So we've got to take control back from the banks and put in place a more effective loan structure, because it all starts with cash flow. We've identified that in our previous show, part 1, part 2. It starts with cash flow and better direct our cash flow with intention. And so cash flow needs to be directed with intention, needs to be directed somewhere. And nearly all Australians have a home loan. And if they don't, they're going to have some borrowing requirements in the future. And if it's not a home loan, it's an investment loan. So there's some kind of borrowings. So directing cash flow through a loan facility. And back to our example, the model we're illustrating at the moment. We've got a couple, an income about 120,000 and another income of 50,000, 170k combined. They've got a tax problem of about 45k a year for the next 22 years. And that gave them that gave them a total tax payable of almost $1 million, 990,000. Then they had a total mortgage cost on their $350,000 home loan over the next 25 odd years. And we worked out that, yeah, you know what, by paying a bit extra along the way, they'll get it down to about that 22-year loan term, and they'll pay about double. So they owed about $350, they'd pay about $700 plus, which meant they had a problem of at least $1.6 million. And what I ask is, look at these numbers and see what they mean to you, how they relate to you, because numbers don't lie, and they're the commodity that's the commodity we use. And from that, we then look at, okay, what are the issues, what are the deficiencies, and what can we map out as a plan to fix that? And I want to welcome one of our new members from today, Simon, who made a really great comment to one of my associates in relation to what the plan we'd mapped out for him actually looked like and what his view of it was. And it was great to do a stock take and start thinking about putting the right things in place to build our long-term wealth. And what a fantastic financially mature thing to say, because that lays out the stock take's being done. What are the issues? What are the deficiencies? What are the needs? And then going forward from there, what does it look like? So this is what we're talking about today: the mud map of what needs to be done, and then some look forward in terms of what it will look like. So the structure, strategy, and solution I'm going to talk about today relates to the example. And the example defined on the income, explained the mortgage position and the issues and deficiencies. There was super. That super left at least a $500,000 shortfall when we looked at what the super balance was of some $260,000 worth of superannuation as available resource. Actually, sorry, it was about 220. We brought it back a bit to be a bit more conservative. So about 220,000 now over the next 20 to 25 years gave them about 1.2, 1.3, and we determined that with that, in all likelihood, based on future value, and not likelihood, the reality, based on what the future value of that money is. So what that money, so that's in today's dollars. If we've got $1.4 million or 1.2, $1.3 million today, what does that relate? What does it translate to? What is the figure? What is that figure in future value? So in 22 years' time, what will that 1.4 be the equivalent of? And it'd be close to about $2 million when you apply a future value calc. So on that basis, there was an identified shortfall that you can't save for. So what are you going to do about fixing it? And that was a question posed in the radio show part 2. Radio show 1, part 2. You've got to keep track of things. So that's what we're going to talk about now. The first thing you do is take control. Put in place a more effective loan structure. A structure that allows you to put more cash flow more regularly through and against that loan. Because interest on loans is calculated daily and debited monthly. So why wouldn't you put more cash flow through and against that loan? The response often would be, well, I can't. I don't have any more cash flow. Yeah, you don't at the moment, but you can do things to generate that. And the first part of getting that facility in place that allows you to put in place a facility to put more cash flow through and against that loan is a very simple product. It's a term loan with a fully transactional 100% offset account attached. So you put in place a 100% offset home loan. And that savings account is attached to the loan. The more cash flow more regularly you put through it over time, so compounding over time, it's going to save you interest. It's going to save you a great deal of interest into the thousands of dollars, if not the tens of thousands of dollars. But on the current situation, that's just all your income. It's your net income. And with the situation where people are getting paid weekly, fortnightly, even monthly, you don't have to have large cash reserves sitting in offset accounts to make it work. If you're earning $10,000 to $12,000 net, or $6,000 to $7,000 or even $8,000 net per month in income, and you've got it sitting in another transactional bank account that's not attached to your home loan, well, it's wasted cash flow because interest on loans is calculated daily and debited monthly. So the more cash flow for that loan, for that offset account attached and offset to the home loan, daily, weekly, or monthly, the less interest you'll pay. And that's in month 1. There are sometimes 360 months in a home loan, 300, 220, depending on how many months, depending how many years are left in the term of your loan. So every month you can save is in your favor because that saving you've picked up in month 1 comes off the principal. And then in month 2, the extra saving comes off the next bit of principal. It has that compounding effect and starts to build momentum in your favor. Now, that's the first step, taking control back from the bank and putting in place the right type of loan facility. Getting your cash flow directed with intention, so all your income into that offset account. Having an understanding of your expenses, so you're not spending all that you earn if you can avoid it. And if you are, we're not going to change your lifestyle, but we'll look at ways in which we can help ensure that you're identifying discretionary expenses that might be able to be saved. But being aware of your cash flow, that's the main point. Because we then want to look at, well, if we agree that putting more income into that offset account would be beneficial, well, how do you do that? And so we need to look at what the options are to generate more cash flow. Other than getting another job, which isn't reasonable, of course it's not appropriate to your situation. Most people are working full-time or working at their capacity in relation to personal exertion. And if there's an opportunity for additional income, well, that's going to help. But just because it's additional income from you working and therefore giving you additional income doesn't mean it's the right solution still. Can you get access to other income? Other income that is passive, that continues without you having to outlay that personal exertion to generate it. And so we look at the options, as I said. Now, to look at the options, we need to go, well, what are they? But how would you even do it? And so the one thing that most Australian households have is equity, some equity. And you have to use anywhere near all of it. And what I'm talking about here is our simple plan, a starting point, where they've got some equity. I have to use anywhere near all of it. And we go, well, what are you doing with that equity? And the answer is often nothing. That equity is not producing any income, not producing any tax savings, and therefore it's not helping. So how can you use just a portion of that, not all of it, to access something that gives you income, tax savings, and allows you to grow your asset pool so you can have an asset that works for you and accesses open market forces, such as capital growth, increase in income. So that's how you're going to be able to get access to that other income. We look at in your current home value, or in the example, we've got a home that's worth, say, $850,000 or $800,000 was the figure, and they've got a mortgage about $350,000. And sometimes those figures are a bit closer together. But in all those situations, there's equity. And it's equity, and then there's what's called available lending value. So can we get access and can we use a portion of that equity, not all of it, to be able to assist you to generate additional income or other income, tax savings, and an asset that can grow your asset pool? Why? Because you need to. Of course, you don't have that at the moment, or you may not have enough. And other income will help you pay back your debts more quickly, more cash flow more regularly. And tax savings will give you access to tax savings that you need because you're paying a full freight of tax currently. So we then look at what are the options. What are the options? Well, there's cash, and there's three options. There's cash. The problem with cash is that cash doesn't keep up with inflation, so the value of cash doesn't rise. The return from a cash term deposit, for example, is much lower than the borrowing rates that you'd pay in your current home loan. So it's ineffective. It doesn't work. You would strike that out. The next option is shares, and shares are a fantastic asset, and shares provide access to growth in the value of that asset over time. The thing about shares is that we certainly wouldn't be recommending, and we certainly wouldn't speak to a client about borrowing against their equity in their home to put in place shares which are an up and down asset. They're a volatile asset, like a roller coaster. And the best way to evidence that is that banks will lend you up to about 50 to 60% of the value of the share. So what does that tell you about their view on its volatility? The other thing about shares is that dividends, the income, are paid at the company or the board of directors' discretion. Like we've seen one of the major banks just now, that they're looking at whether or not they'll pay a dividend because of their situation. And you don't want to be in that circumstance. There are tax deductibility with some types of shares, and certainly the credits that you get from holding a share, such as franking credits. But in relation to a shareholding, other than anything you might have via shares you've accumulated to date, that asset is often best held and sitting within the super environment. Unless you've got the ability to put cash to work, and even then we'd look at what is the most effective way to use that cash, and is a share acquisition the right move. So what we're saying is that it's got some pros, and it certainly is something that should be considered as part of your total financial world. And what we see shares mostly held with our clients is in the super environment, that the majority of their super is invested in shares. So let's keep that option open and then go to option 3, which is property. Now, property is an asset that gives you 3 things: income, tax savings, and growth. Now, the incomes are reliable in the form of rental income. The tax savings, if it's the right type of asset, right type of property asset, can be some of the highest and largest amounts of tax minimization advantages you can receive. And often in the form of depreciation, or a large chunk of that in the form of depreciation, which is a non-cash deduction. That means you have to outlay cash, you have to fork out $1 to get $1 or $1 deduction and some of it back in tax savings. Depreciation is a non-cash, it's built in to whatever you acquire in a property asset that gives you automatic, getting to qualify, automatic deductions you're actually having to pay the cash for. So depreciation is a big benefit. Of course, property has 2 components, the land value and the building component. The land value appreciates and the building value depreciates. That's where you get the depreciation from. So property, and again, back to the banks who for 200 years plus in Australia have been lending. So they've got this expertise, and banks are an important part of our process or third-party verification to ensure that we're stress testing it and we're getting those third-party set of eyes to check and test everything. So what pops out at the end or what comes out at the end is something that, as I've described before, you can't hurt yourself on and does exactly what you need. Is creditworthy, and a solution for the long term, as well as being appropriate in the short to medium term. Now, with that, so banks will lend you up to 90 or even 95% of properly valued property. So a bank value or values that property will lend you up to 90 to 95%, as compared to option 2, which is shares, will lend you up to maybe 50 or 60%. So again, what does that tell you about the smoothness in that valuation and the underlying value and how it holds its value over time? Well, property is a smoother ride. So then you look at what we're talking about here is the client's personal situation. So we would not be talking to a client about borrowing money to acquire shares, which has an increase in risk against a volatile asset. And we would therefore, again, based on that volatility, leave that for the super environment and perhaps as supplementary in the event people have cash reserves they want to put to work, but it's not the primary strategy, solution we're going to put in place. So let's strike number 2 out, because it doesn't give us the foundation we're looking for as part of a simple plan when it comes to your personal financial world. I'm going to touch on that now. So a personal financial, so when we look at a client situation, we look at that as a whole. And imagine you draw a circle. And again, we draw a circle and then we split that down the middle. So we draw a line down, straight down the middle. Gives us two worlds now. One on the left and one on the right. The one on the left is your personal financial world. And we call that part 1.1. And on the right-hand side of that circle, the right-hand side of your world, is the super world. We call that part 1.1a. Why are they named like that? Well, they're just as important to each other, but the two shall never meet. Well, at least until you retire. So, in your personal financial world, the part 1.1 world, we're going to look at putting an asset in place that is a smoother ride, that gives you access to regular reliable income in the form of rent, tax savings at the maximum available for your circumstances, and access to growth over the means of long term. Now, just back to that comparison of option 2 versus option 3, there is always space for an asset like shares. In your financial world, like in our examples, it may be that it's best placed in the super environment, your part 1.1a world. Now, if you look back over history, and for the last 10 odd years, Russell Investments and ASX, so the ASX, the Australian Stock Exchange, are putting out a report as to what is the best performing asset. They look back about 20 odd years, so prior to the GFC, and then through that period and through to the most recent year. And the best performing asset in Australia has been direct residential property, outperforming international shares, Australian shares, and the other usual suspects, fixed interest, listed property, all that kind of stuff. So what we've got there is a situation where plugging in, integrating a direct residential property asset is going to fit the needs and give you the foundation to start with, to start to build your plan going forward. So how do you do that though? And the thing is, if you went back to your current funder or to a bank and just walked in, what you'd often see is they go, well, yeah, great, and you'd explain, well, I want to acquire a property, I want to start to get ahead. And they go, yeah, great, look, you've got this equity here, we can lend you a loan up, give you a loan up to say $500,000. And what would happen there in most instances, in nearly all instances we see, is that they would then take that asset looking to acquire, that property asset, and plug it into and against their home. And so they would cross-collateralize it. So they've got that equity in the home, and the bank goes, great, yeah, we can help you with some additional borrowings, and they attach that new borrowing and that new property as security against the existing home and the existing loan, so it's all cross-collateralized. And that means that a client has the risk of being overexposed against their home, as well as the contingent liability of having that cross-collateralized or security for an investment loan. There's a far better way of doing it. So do not cross-collateralize. Keep everything standalone, and gives you and keeps the integrity of the structure that we need and we put in place, and it keeps you in control. So we go, well, we've identified to get access to the income, rent, and tax savings that this person needs to start with as part of their plan for their future. It's a foundation. because it's going to give tax savings to assist that person. It's going to save them a great deal amount of tax each year. It's going to give them other income in the form of rental income, which allows them to access open market forces of rising rents over time. And it's going to give them access to an additional asset that might be, if you look at, and we'll talk about the fundamentals and criteria of what the right type of asset is in a bit, but it might have, based on those fundamentals and criteria, a value between, say, 400 to maybe 550,000, or, yeah, let's work on that range. 400 to about 550,000 will give you the ability to look at the assets that certainly satisfy the criteria to be appropriate to plug in and start to do a job for you as part of your portfolio. So the way to structure that, though, is keep it all standalone. So that's where we start to do some backward planning. Okay, well, we've identified the asset type, we've identified the kind of price point it sits in, or the range, and the price point, let's call it, say, 500,000 for ease of numbers. And it's always easy to bring the numbers back rather than take it higher. So let's take it to 500. We can bring it back a bit if that's what's most appropriate to the client as we start to squeeze this. But on our assessments, it looks like it's certainly, well, not looks, we don't deal in the grey. It's black and white. It is certainly affordable and creditworthy. So we got a $500,000 asset. And remembering the fact that banks will lend you up to, say, 90% and up to 95% in some instances of the value of a property, well, the benchmark number that we always start at is 80%. And why? Well, our structuring goes through, well, the business case. So we're working on your corporation, which is the business case, and our structuring is all about the numbers. And we then are doing, as part of that, a cost versus benefit analysis. And anytime you're borrowing above 80%, you are going to start incurring what's called lender's mortgage insurance, LMI, lender's mortgage insurance. So if we can avoid that, we're appropriate. And remember, we're trying to use the appropriate and sometimes the least amount of equity from a client's home to allow them to integrate an asset. So the deposit might be best at a 20% level, so a 20% deposit coming from the equity in the home, or 10% as an example. In this situation, of course, we're doing assessment as we go, and we're really structuring something using our expertise. We can see that an 80% lend against that asset would be the benchmark. It is always a benchmark, and be the best starting point. So we've got a $500,000 property, and therefore a loan at 80% is $400,000. So we've got a $400,000 standalone loan attached solely to that property. And it's a big firewall down the middle. So we're at lender 2 for that. Remember, we're doing the backward planning, and your home loan's at lender 1. So we've got an asset worth $500K, and we've got a loan attached that is $400,000. Well, where's the $100K come from? Where's the difference? And remembering there's some costs, and that's the cost versus benefit analysis. So there's entry costs, such as stamp duty, any professional fees, solicitor conveyancer costs, bank costs, and they're all taken into account. Let's say that we call that about 115, let's round up 120,000, and then we want to have a buffer or contingency. So let's call it 130,000 of, and that buffer and contingency is money that's sit there as a contingency, redraw, funds you shouldn't have to access. It's there to give you that head-on pillow situation where you can sleep knowing you've got some cash reserves as part of prudently structuring a business case and a strategy for your long-term future. So we're needing about 130,000. Well, where does that come from? Well, have you got the cash? Is there savings sitting there? Well, no. And even if you did, it wouldn't, in the first instance, be the best way to do it, because if you put a cash deposit into a property asset acquisition, what instantly happens is it affects your return on investment, your ROE. Of course, if you look at it as a comparison, especially at the moment where you can borrow 100%, so the total borrowing amount, so the 100% of the purchase price plus costs. So you don't do it in 100% loan like the banks we talked about in my earlier example. You keep the loan standalone, but you borrow 100% of the purchase price plus costs. And you do that by having a loan of $400,000 against the investment vehicle that's being targeted, and using some of that equity we identified in the home. And we need about 130K. So by using that, it allows you to use the bank's money, allows you to have the tenant and the tax savings hold and pay for that asset. So you're really acquiring that asset, putting it on your balance sheet, being accountable for it, of course, because it's your asset. It's going to give you a stepping stone for your future, but using other people's money. It's called leverage. And that will give you an improved return on investment, far better one than actually having to put a cash deposit. The numbers are that return on investment reduces as that deposit increases, because in this situation, when we look at rent from that asset, say 5%, so a 5% rental yield, and borrowing rates in the threes or even low threes to even twos now, we can fix in the 2.5% range for a fixed rate principal and interest investment loan, and combining tax savings, well, the numbers show that it doesn't actually cost you anything to hold. It's simply managing the cash flow. So the return on investment is far greater in that situation. So we've done the backward planning. We're partway through it. We've done the backward planning to the point where we now can look at where the deposit comes from. So we've got a $500K property and a $400K loan, and we know we need about $130,000 in funds as available for deposit and costs and contingency. Well, we've identified then in the home that there's some equity sitting there, and we're not going to use anywhere near all of it. We use the most appropriate and least amount that's required, and that's $130,000. How we do that is by splitting your loans, or having two separate and split loans against your home. We've got the home loan, which was about a $350,000 facility. That's got a term, that is a term loan with a fully transactional 100% offset account attached. And that's what we call your A account. That's your home loan account, it's your personal debt. It's non-tax deductible home loan debt. It's the most expensive form of debt. Because if you go back to our radio show part 2, we looked at how people earn their income, again drawing a circle. The income comes in, the first thing that comes out is tax, and then your mortgage payment's paid. So it's paid in after-tax dollars and gives you no tax benefit. It's the most expensive form of debt. We want to get rid of that debt as quickly as possible. So we do a principal interest loan term, and we pump as much cash flow. Now we've got your income, we've got rent, we've got tax savings going through that. And the tax savings, how do you get the tax savings? Well, you can get a large amount of tax savings through the property asset meeting the right fundamentals and criteria. And that would give you the tax savings will come in the form of deductions against your income, and then that reduces your taxable income to a lower level and gives you cash back. So more specifically, if you're on $120,000 and the rent that you get for your share, because you on the ownership structure own the majority of the asset in your name, it might give you 90% of the rent. Let's call it, say, $22,000. So we're up to about $142,000 in taxable income. And the problem is, if your property asset isn't the right type and doesn't have the right type level of tax savings, it's going to give you a tax problem. It's going to mean you're paying tax because your income's gone up. So you don't want to have that. And we see that a lot where assets, people have their structures inside out or wrong way around. Too much owner-occupied debt, not enough investment debt, assets that are older with not many tax savings, if any, rental yields that are high as compared to those other non-cash benefits such as depreciation, the tax savings, and even the loan facility. And those structures occur through people's movements over time. So you've got to be able to fix those because it's ineffective. But back to this scenario where you get $142,000 in income plus your share of rent, and you've got tax deductions in the form of depreciation, loan costs, which are amortized over a 5-year period. So you claim them over a 5-year period. Interest on the loans, and interest rates are low at the moment, so interest cost is lower. That's where you need the right balance in terms of a balancing different vehicle. Having a newer asset that has depreciation is a good tool to assist in tax minimisation advantages. You've got the expenses such as property management fees, insurances, rates. And let's just say that they mean that your share of the tax deductions is some $45,000 to $50,000. So that'd take your taxable income down by, say, that $45,000 to $50,000 amount. And all of a sudden, you're only paying, your taxable income is around the $90,000 mark. So if your tax that you're paying is at $90K rather than $120K, and when we squeeze the numbers and look at it more precisely, those tax savings could indeed be greater. But we're going to see that you get tax savings in the form of real dollars back in your pocket. and that could be in the form of $5,000 to $7,500 to $10,000, depending on the level of deductions from any asset as applied to your income. But let's say it's $7,500 for this example. That's $7,500 cash back, real cash back in your pocket. And how do you get that though? Well, you can lodge your tax return at the end of each year and get a lump sum of say $7,500 and maybe more, and that's typical to what we see. But I'll be conservative right now. And that's $7,500 that goes into your home loan, because it's not money you've had before, and so it shouldn't be spent on something else, and it's only come because of that property asset. So you've got to put it to work and make sure it's sitting and saying where it should be. The other way to get it is in the form of a tax variation form, a PAYG 1515 tax variation form, where what you do is you